Alright guys, so on to the next part. We're going to be going over when you enter supply or demand zones. And there'll be a lot of examples over the whole course, but yeah, one thing you never want to do when it comes to supply and demand zones and entering is just enter right at the zone. Um, like you do not want to set a predetermined order and stop loss set, so when it touches the zone, then you just get your order gets filled and you hope and pray that it goes back and reverses the other way. You do not want to do that. We're mainly watching when we're at supply zones or demand zones is selling wicks or buying wicks. And we look for higher highs, higher lows as confirmation. Some sort of pattern in the zone is usually really, really good confirmation. And one of the best ways of confirmation of trades is some sort of pennant, double top, double bottom, any sort of pattern. Yep. And it'll make it much more valid. So let's take a look here. So, for example, some people, a lot of people think that they can just enter the zone right when we touch it, right? So let me just show you why you would not want to do that. So this morning, this was a 30-minute demand zone right here that was on I had on my chart. Okay, we'll pull up the 1-minute chart, and I was in short somewhere around here, and I sold I think around here. But let's say you had an order right here, right at this red line, and that was preset, right? And it was a buy order, a long, right? Because it's at demand. And then you set your stop loss below this level, below this demand zone. First of all, that's a pretty big loss since this zone starts at 41.30 and goes down to 41.15. It's around 15 points. It's a pretty big loss. And there's no signs of buying in here, right? And just because you see these two green candles, that doesn't mean it's going to reverse back up. There's really no buying volume. I mean, there's some buying volume here, but it's not heavy volume, nothing crazy. Same thing here, a little more selling volume. None of these candles have big buying wicks on them. This has a big selling wick, a pretty big selling wick at least. So nothing's really showing you to actually go long, right? So you also don't see any sort of pennant forming. I mean, this just dropped right through this demand zone, which you do not want to. That's why you don't want to set a predetermined order there. Now we keep coming down through the day, right? We touch this 2-hour demand zone. What do we notice? First of all, let me change this color. There's kind of a little bit of a resistance line right here. And if we connect down here, it's kind of a downward wedge, right? Falling wedges are usually a bullish pattern, right? And the thing I like is we touch this zone and instantly break out after. So you could have gone long somewhere around here, right around after we get this candle has a lot of buying volume on it, right here. It's all buying volume, and it's quite a bit more volume than we've had recently. So you go long there, you set your stop loss below the low. You target really anywhere you want, maybe these VWMA bands. You could target VWAP, which is way up there. If you didn't sell anywhere in here, you would have gotten stopped out here. But the good news is if you look at maybe a 5-minute chart, you'll see a different pattern, or a 15-minute chart. But this was a falling wedge pattern. Could have gotten a scalp, right? Here we drop back in demand. There's no double bottom because we actually make a new low here. We make a new bottom. And then we bounce back out. There's no real trend line anywhere. That's too steep. So this, you could have just played off of volume. Okay, so we drop into this demand zone. We're picking up more volume once we touch this zone, which is a good sign that there's people here, people ready to buy. or get out of their short position when the volume's picking up. That means, other people are seeing the same thing as you. And when you see this candle right here, a big bullish engulfing candle, we swallow up this whole candle in front of it, and also these previous two candles, right? If we look at the volume, 5.2k buyers versus 680 contracts of sellers. A lot more buyers than sellers right here in this candle, and we break well above this demand zone. And by well, I mean 3 or 4 points. But this candle was around 6-7 points in value. But there's just tons of buying volume. You could have gone long just after that, right? And then set your stop loss below the low, which is right around 5-6 points, depending on your entry. And then your target, maybe you scale out a little bit at these bands, just because sometimes we tend to reject. But then your main target's going to be VWAP, right? So if we put our main target at VWAP, there's 35 points versus a 5-point stop. That's a 6 risk reward. Maybe you scale another contract out here. Maybe you have one more for a runner, right? All the way up here to the supply zone. But whenever you're scaling out, so if you scale out, if you're in here and you scale out, let's say you have 2 contracts, you scale out one here, now you want to move your stop loss up to break even, okay? So now no matter what, it's a winning trade. And then worst case scenario, it comes back down, you stop out, but you're still up. You're still up in the trade. Another example here. This example, forget about this 2-hour zone right here. Just kind of minimize that. So this 4-hour zone was what was formed this morning. This 2-hour zone was not here. So again, you don't want to enter just right at the zone. It's just not smart. It doesn't work out often. Okay. If you did, it would have worked out here. If you bought or sold here and put your stop loss up here. But it's just not a smart way to play these kind of things. But one thing you notice here, right? I was actually in short right here this morning. Put my stop loss above the high, and I got nicked out right there. Stopped out right at the tippy top, and then it knifes back down. But it's okay. I stuck to my plan, right? I got back in right around here. Once I saw this huge rejection, huge selling volume come in, I got in short, and I put my stop loss above this candle, which was around 10-11 points. Actually, I put it right above this candle because I didn't want to risk too much. So I put it right above this candle, so it was around 5 points, but I think I was actually in right around here. So it was about a 10-point stop. I got a very late entry. I stuck to my plan though, and I ended up selling right around here. There was some reports that came out at 10 o'clock, and it dropped 20 points in 1 minute, and almost went back up 20 points in the next minute. So it was too volatile, too much risk. When those happens, those reports or FOMC come out, there's super volatile. You can go up and down, crazy numbers. My main target was demand, which if I held, we obviously could have hit. But hindsight, it's just, that's hindsight. But yeah, in short here. And if you miss this entry off of this huge rejection with nice selling volume, the next thing I notice is this double top, right? It looks a little better on a 5-minute chart. So if we look at a 5-minute chart, where are we at? Over here. So we top out in this candle in supply, big rejection, right? We kind of come back up, and all you need to qualify for a double top is for this candle to be within the body of the previous candle that topped out. So this candle was the top over here, this candle was the top over here, and this new top kind of hit the body, right? It hit the body of this previous top candle. So this is now a double top, and then what do we see? Volume starts to pick back up, sellers start to kick in. Take that short right there. Set your stop loss above this candle, right around 7-point stop. Set your target at demand. That's your ideal target, is demand, right? And we hit that. And maybe you scale some out at demand and leave some unless you see some big buying come in. And on a 5-minute chart, we see no real signs of buying, right? This has a little buying wick, but still all selling volume. Here, selling wick, lots of sell volume. Here, big sell volume candle. Selling wick, selling wick, selling wick. Maybe you get out here once you get these buying wicks and big buying volume come in, which that would have been a 50-point trade, which is huge. But yeah, we'll go over a lot more examples of entries, exits just throughout the course. But do not enter. That's the main gist. Do not enter a zone right when we reach it. You want to look for some sort of rejection, whether it comes to selling wicks or buying wicks at demand, and you want to use some multiple time frame analysis, right? Look for patterns. There's a double top, right, in supply. Here we kind of have a pennant breakout right here, or a downward wedge breakout. Yeah, so those are the main things. So there'll be more examples throughout the course, so on to the next part.